Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is March 29th, 2015 edition of Market Outlook. Don't forget to sign up for this at www.marketgauge.com and receive our commentary and video presentation each week. All right, well, markets definitely had the pause after Yellen's announcement and removal of the word patience, although it definitely surprised some investors and traders as the maximum move we got was the day of the announcement with no follow through and a pause at the highs. So, a couple of things to note. Um, First of all, this is the S&P 500. You can see the trend line here um, basically was broken along with a phase change midweek. So as we stay under this broken trend line, definitely cautionary. The other thing that's interesting to note is that we really ran out of steam virtually at all-time market highs before getting a nasty 2.5 to almost 3% sell-off this week. Now, regaining the 50-day moving average, getting above the trend line is important, but you still now have some interesting overhead as well. And in fact, what we can do is draw another trend line from the recent highs, and that's going to be another critical area to take out. So in terms of momentum, definitely working off a very, very short-term oversold. We had two distribution days in the last week or so. We also had two accumulation days over the last couple of weeks. So not really clear if the big institutions are distributing or just this is just sideways action. Nonetheless, a move back down beneath the lows of last week would definitely threaten a very important support level. Let's get this horizontal line here. So if we take out those levels, that's been a critical level for quite some time now. This is going back to early February before we took off and made new highs. So we definitely want to watch those lows put in. That's around the 204 level. Certainly on an intraday basis, we can tighten it up a little bit. Even 204.20 seems to be fairly important support. With that, if we took that out, we'd definitely be looking at maybe a move down to the 201 area, which is critical support as well as the 200-day moving average. Now, one thing that's a little bit more promising is on the weekly charts. Let's take a look at the weeklies, and you can see I put in this trend line here, and on a weekly closing basis, we have not broken down. So clearly, those players, the bigger players looking at weekly closes, are definitely going to be looking at that 204 region to hold by the end of the week. So weekly trend intact, can't really argue with the rising 65 week moving average, the 200 week moving average, all those trends strongly intact, and of course the monthlies as well. So longer term, looking overall that the trend is in proper gear. Short term, going back to the daily charts, over the last 4.5 months, pretty much sideways action. So, of course, we're always going to get the tell on the shorter term time frame first, generally speaking. And in this case, definitely the sideways action, extremely choppy, hard to get real momentum across any of the stocks unless there's some extraordinary news. But overall, sideways action over the last 4 to 5 months. Let's see how this resolves. So interesting, you sort of have this wedge formation. Let's see what the market can do. And again, always let the market tell you what to do and how to respond. So let's take a look at IWM. Completely different story. Um, although um, the action on Thursday, Friday, and Wednesday was definitely a little bit questionable. We did get up to the upper end of the Bollinger Bands, came back off. We definitely got overbought and oversold within a couple of days because of this violent action. So, what is interesting, we did break out to all-time new highs. Let me put in this horizontal line of resistance, and you can see again the pattern is that we broke out to new highs unlike the spiders and then corrected back but into support. So that is promising. Now all of that happened on relatively modest volume. You did have some pretty decent volume on that initial breakout to just before we hit the new highs, but nothing really massive. No major institutional buying seems obvious like we got on some of these big up days earlier. And in fact, the biggest volume day was to the downside. So very important that we hold this rising 50-day moving average, as well as the support level right around the 120 50 level, the 121. This is critical support level, because if we take that out, right, this was a breakout to new highs, a retracement move back into support, another move to new highs. If we take out this will be considered a pretty important swing point right here, and you'll have trapped everyone that was looking at IWM as potentially the leading index, including us. Now we did this. We took the trade here, basically scaled out before the big drop, and actually we got out. I was part of our tail just as the market was coming off this day here, and we're now watching for direction in IWM. But again, this is definitely more supportive than the SPY. If we look at the DIA, sort of a more deteriorating formation, you can see how we're actually now trading under or at the support levels from a week and a half or 2 weeks ago. We rallied up there, moved up on Yellen's announcement, actually had a little bit more follow through afterwards, but then came off and broke down pretty hard and traded under where we started from before the Yellen announcement. So overall sloppy action in the Dow. This is definitely looking a bit heavy, but we can certainly recover that 50-day and also that 10-day, but you're going to have to take out all of that resistance as well. Now on the flip side, good support. So sideways action again. We're now trading under the November December period, or around in that zone. So the Dow is definitely acting as one of the weaker indices, which is not surprising considering the strength of the dollar. So that sort of wraps it up on the indices, U.S. indices. Let's take a look at gold. We had pointed that out in the last couple of weeks, and as you can see, we had a really nice rally off of these lows here. You had what we call the key reversal pattern against the lows here. You do have a declining 50-day moving average, a declining 200, rising 10. So let's see if we can certainly hold the breakout levels or a 50% correction back down to the 10-day, and that would be telling. Now, clearly the volume has not been heavy here, and we did get a bit overbought, but the market held up relatively decently on Friday. So let's make sure that we keep a track of gold. Potential double bottom is in place. Okay, a couple things. Let's go take a look at market internals. The volatility ratio, long term, what we consider 3 month versus 1 month, you can see we were definitely in frothy territory. The market responded by pausing and then selling off very, very sharply. We're now neither overbought nor oversold, and I would say this is probably more neutral than anything else. Um, Perhaps with a slightly negative slant, because usually what happens is you go from one extreme to another. So we got an extreme overbought reading at virtually 1.3. So I wouldn't be surprised to see it work its way down. But really, you got a pretty good size sell off, 2.5%, 3% from the overbought conditions that the sentiment here was showing, and overall more on the neutral to slightly negative for the market on this particular indicator. Let's go back to taking a look at the VIX here as well. Okay, so VIX was interesting in the fact that it gave us a pretty good sell signal for the market. Down here, we got, as you see, under the low end of the Bollinger Band. And by the way, this is also on an absolute level pretty low. Let's take a look at some of the longer term charts. Taking a look at the weekly charts, you can see that VIX historically here is at an extremely low level, down here to that 25 zone. So on an absolute basis, longer term looking out, market is relatively complacent. On a very short term basis, we're still on a sell signal. It could take a week or so to work this off unless something really materializes and this VIX takes out its 250-day moving average. That 30 level is really very critical. So let's watch this. If we can take out the highs of Thursday, that would be pretty interesting and probably give you a test back up to the upper end of the Bollinger Band, which is around the 29 level. So that's still a pretty good size move. This is trading around 25.60, 25 to the 26 level. So a $3 move off of a $25 priced stock is pretty good. So overall, looking probably for a little bit some more potential weakness looking out over the next week or so. But again, we really want to see this thing VIX take out the highs, and again working off that really frothy overbought condition right after that Yellen speech. We continue to just, as you can see, drift down in volatility to the point of complacency of under that Bollinger Band. All right, let's take a look at oil, USO. Caught a nice pop in this off the lows. A lot of it had to do with some of the unrest in Yemen, potentially disrupting the oil flow out of the Middle East. And you got a really good size rally. We picked it up right here at the low end of the trading range, right? You had this key reversal pattern. The next day it gapped lower after I think it was after that Yellen speech. We picked it up here on this day, scaled out of it as it tried to take out the that 50-day moving average. Again, this is clearly a counter trade. Overall, a couple of closes above that 50-day moving average would be an indication to us that the down move in oil might be over. On the other hand, just looking at the longer term trends, you can only say that this was a counter trend move, caught a nice little bounce. Let's see what happens. The close on Friday, although up on the week, not that convincing. As you can see, this now looks just like compression in sideways action. So again, real confirmation of the trend moving back up, on a weekly basis would be a close above 20. On the other hand, close down here under the absolute lows, which is around the high 15s, would not be a good sign. And you can say the market would be looking to go again even lower than the already low oil prices that are around. All right, one thing I did want to show was this ratio chart, and let's see if I can find. Okay, let's take a look at gold versus the S&P. So one of the things I pointed out in the text version, let's take a look at what gold has done versus the S&P as far back as 2006. So this was really as gold was really getting its mojo together, and the highs on gold relative to the S&P was around this 0.55 level. As you can see right here, there's my cursor. The red there is the absolute ratio between gold and SPY. GLD, the ETF on gold, and SPY, the S&P 500. So you can see in 2006, you got up to that 0.55 level. It paused there for almost and just traded under it until 2007, and then in the beginning of 2008, gold just exploded and went up for several years, for a good 4 years, as we were sorting out the financial crisis. Now recently, gold has been going counter to the S&P as this ratio is declining. But look, we're back to where we started, and so that's an interesting point, as gold on a absolute basis looks like it potentially double bottomed, and the longer term value of gold relative to the S&P is pretty much back to where it was before it really exploded. So if gold is starting its basing action and looking for a resumed leg up, this would be the point to hold in this particular relative value basis. All right, hope this helps. Market's definitely at an interesting point. We talked about certain valuation measures in the text, so we're clearly at overbought. But again, it can stay overbought. The markets on an absolute value basis can stay overbought for quite some time. But I do have a very close eye on the exit in equities. That's it for now. Have a great weekend, whatever left of it, or if you're going to see this Monday morning, have a great trading week, and see you next week.